matter. I just want to, introduce. I just want to introduce Tanaka's formula for the continuous sum of martingales. So what this formula is doing is that for the continuous sum of martingales, you can decompose in an option like payoff into its intrinsic value and a gains loss process, which I will explain to you shortly, and also local time. So I think the term local time is a little bit new, but you can think about the local time as a slice of volatility. Is kind of connected to the quadratic variation of the G process. G is essentially the gross return on the futures contract. And here we are going in the space of the futures contracts because and because it's a Q martingale, and all expectations of the gains and loss process will actually vanish. The second term that I have over here is essentially like a stochastic integral, and it will have an expectation under P and an expectation under Q. But just like I said, that the expectation under Q of this term will be 0. So you can actually associate the second term to be the risk premium on the upside in this case, over here, but there is a corresponding one for the downside. So so this is very useful in the case of option payoffs, because when you're defining option returns, it's essentially P expectations divided by the Q expectation, and you can very succinctly write down the option payoff into a term that's connected to the downside and the upside risk premiums and the local time risk premiums. So, and I'll be describing these terms as we move along. But over here, the main idea is to use Tanaka's formula for the sum of martingales. We can also generalize in a certain way to study the impact of jumps on the option risk premiums, and that's there in our result number 4. It's a little bit more complicated, and you need more assumptions. It's not as clean as going after the continuous sum of martingales. So keep in mind that the continuous sum of martingales are the basis for most of the premium models in finance. So this is our framework, and we are going to be making some points about the unspanned risk versus spanned risk in the pricing kernel. So M is your pricing kernel, S is your equity price, and V is a vector that's going to determine equity index variance. So as you can see from here, there are a number of differences from how in the way that we are modeling in the way we are modeling equity volatility as well as pricing kernel dynamics in the sense that they're unspanned risk. So what we call unspanned risk over here are risks that cannot be spanned by the equity futures or or the index. So you'll have unspanned risk in volatility, and you'll have unspanned risk in the pricing kernel. And this framework can be, and I'll show that as to how this framework is going to be different than many of the processes that people have been using in finance, including the Heston model. So here the drift may not matter, but here you can see that the drift is being determined endogenously in our framework. So there is a distinction between spanned risk and unspanned risk, and this is going to be a very key focus of this paper. So just some housekeeping. P is just expectation under P, Q is expectation under the equivalent martingale measure, G is quadratic variation, and delta is a delta function. So there's a formalization of the local time as half the integral of this direct delta function times the d of the quadratic variation. So just like I said earlier, one can think of the local time as a slice of this integrated variance, where the slice, it corresponds to the case where the process G is precisely equal to K. So it's measuring uncertainty over a certain narrow band in the data. And as you will see, this term, or the risk premium for this term, is going to enter into the option risk premiums. So before I go forward, it's very important to make the point that equity risk premium is positive, and also we have equity futures premium that's going to be positive. And note that this term is going to be zero because because the Q expectation of the futures price is zero. All right. So what we did is that we used Tanaka's formula, and we went into the expected access in returns of calls and the puts, and we are able to write down the expression for the expected access rate of return of the option into a local time in risk premium and an upside risk premium. And then similarly for the downside or the puts, you can do it that way. Now you can see, we all know that put options are or the average rate of return on the put options are highly negative. So if the downside risk premium, this term it should be positive because equity risk premium is positive. I mean, even though this term is saying that you're buying when the market is falling, I mean, equity risk premium is still positive. And this term we will show it to be negative, and hence it's very easy to actually interpret average put option returns negative and negative, so they become much more negative theoretically. On the other hand, if you look at calls, you see that this term is positive and this term is negative. So these two terms are going to offset one another, whether you're looking at the first horizon or the second horizon, and so on. What this is saying is that the average call returns, either conditionally or unconditionally, it will be an attenuated version of the put option risk premiums. So this is the main observation that we are making in the paper, and we are saying that this guy over here is, or this guy over here, which is different for K greater than 1 or K less than 1, is essentially the dark matter that's showing up in the option returns. So let me just define what I call dark matter. So the dark matter in the option risk premiums refers to the local time in risk premium at money in SK, the source of which is unspanned risk. Now, this is a very important result from our perspective, because we are saying that if there are no unspanned risk, then the local time risk premiums are going to be zero. So I mean, intuitively, if there are no unspanned risk in the pricing kernel, then the P expectation of local time and the Q expectation of the local time is going to be the same, and the local time risk premium is going to be zero. So think about the Black-Scholes model where you have sigma is a constant. Then the local time risk premium is going to be zero, and the only thing that's going to be left in the Black-Scholes model is basically going to be this term and this term. So I mean, you can imagine that if the pricing kernel is monotonically declining, then the call returns will always be positive, and the put returns will always be negative over here. But there are certain features of the data that the Black-Scholes model cannot explain. In particular, you can see that in the case of Black-Scholes, I mean, the expected access rate of return on the calls should be positive. Now, one thing that is surprising that we will show later on is that even in the Heston model, which has no unspanned risk, it's very hard because even in the Heston model, you have spanned risk in the volatility dynamics, but that's all going to show up over here, okay? And it's not going to show up in this term. So even in that model, it's going to be very, very difficult to show that the expected access rate of return on the calls uh, is is negative, which is consistent with the data that that I'm about to show you. So just like I said, I mean, the data is suggesting local time risk premium is negative. And we are also trying to make the point that it's easier to identify the presence of this local time risk premium from the call option return than from the straddle returns. And I will make this point clear as I show you the result. But it's easier to identify the dark matter from the call option returns because you have the local time risk premium counteracting this positive futures risk premium on the upside. So you can see where this effect is really showing up. Yes, I mean there is some relationship between the local time risk premium and the dispersion risk premium and also the variance risk premium. But what is really going to matter for the option returns of a particular moneyness is that particular slice of volatility. So that's the point that we're going to be emphasizing, as we move forward. So, I just wanted to also introduce Winston's paper on dark matter in asset pricing models. Our focus is actually different from theirs because we are focusing on the dark matter coming from the local time risk premium in the option risk premiums, and we are trying to identify this matter. And when we go to a forecasting, regressions of option returns, I will also point this thing out that it's very, very hard to predict option returns. And we are still working on that part, but I'll be able to show you some of the numbers or the results. All right, so what are we doing? We're showing the relevance of the unspanned risk in the volatility dynamics. We are showing the relevance of the unspanned risk in the pricing kernel, and we are making the case for this dark matter. It's very hard to identify, but its effect is very important, especially if you can identify it from the call option returns. So models that are actually absent of the unspanned risk cannot explain negative average in returns to call for high K. So when I say high K, it means that they have a low delta, basically. I mean, so if you have 10 delta calls and you compute the returns for 10 delta calls, then they will be negative. But there's also this issue of both sign and the magnitude of these average option returns, which our model kind of helps to see some of these magnitudes and signs in the data. Okay, so how do we identify dark matter? So this is one result that we have in a paper, which is basically saying that the expected excess rate of return of an OTM call can only be negative if and only if this local time risk premium is negative pertaining to a particular K. Okay, in general, it should be essentially negative throughout the entire continuum from 0 to infinity, but there will be some differences between the local time risk premium on the upside versus downside, and also there are going to be differences in terms of the relative risk premiums. And on the other hand, this term can be positive, or the excess rate of return on calls can be positive if the upside risk premium dominates. Now, this, I just wanted to go back to my slides over here to see as you go deeper and deeper out of the money, as K increases, small k is increasing, then this term is actually getting smaller because you're going way in the tails. You're computing in a tail risk premiums or on the upside. And also the same thing for the puts. That term is getting smaller, but that's being divided by this by the Q expectation of the L, and that term is getting smaller because as you're going deeper out in the tails, this is essentially your undiscounted option price. Okay, EQ of this of the local time. So this term will get bigger. But this term by itself over here, this upside risk premium is getting smaller. Now, depending on the interaction of the two, I mean, you can have positive access rate of return on calls for near money options, but if you go deeper for small delta, like 10 delta, then the term will become negative. I mean, that, and over here, it does not matter for puts because puts will always, should always be negative. So, I mean, I'm not aware of any empirical, I mean, evidence that says that the puts, out of money, they have positive average returns. They're all negative. So this is consistent with the theory that we're putting down in this particular decomposition that we are, putting forth. So now we can essentially identify uh, that that the local time risk premium is negative from the straddle returns. So this condition is basically saying that if things are symmetric on the upside and the downside, so if you're taking a long position in the futures on the uptick and a short position on the downtick, then it's implying, and you compute the rate of return on this futures position, then it's basically saying that the net position is unforecastable. So in that particular case, the expected excess rate of return of a straddle is going to be negative if and only if the local time risk premium is negative. And in the data, the straddle returns, average straddle returns are actually negative. They're also negative conditionally. Now note that this theorem that we have, or the result that we have, refers to the conditional risk premiums. And sometimes it's very hard to pin down the conditional risk premiums. So, but we can also show a result that that these will hold unconditionally as well. We have a proof of that where we're taking certain positions to show that the average rate of return on the calls and the straddles for particular K can be negative. Okay. So, just like I promised you earlier, the interpretation, we can tie the slice of this local time risk premium for a particular K over the entire continuum. And that entire integral with this particular weight that's over here, we can show using Tanaka's formula that if you combine all these terms, then it tantamounts to the risk premium on the squared log contract. So it's basically saying that if you take all the slices of the local time risk premiums, they will actually sum up to the risk premiums on the squared log contract. And the interpretation is very clear from here that we're just trying to measure volatility around a particular small slice, and the integral of the whole thing in the entire continuum will give you the risk premium on the squared log contract. So what are we doing empirically? We are showing that average call returns are negative at high K, say 10 delta. We're going to show you that the average rate of return on straddles are negative. We're going to give you some evidence on the conditional option risk premiums. We're going to show you some results on say predicting option returns. And we are working on the extensions to the international equity indexes. We have some results, but we are verifying all of that as I mean, this is still work in progress, so we don't have all the results, but we are extending these results to a broader arena if we can. So here are the numbers on the equity futures, and I'm only showing you the results for calls over here because puts are put average rate of returns are all negative. So log K is the percentage moneyness, so 531. You can see that for 5% out of money calls on the futures are negative, and also this is also negative. But note that we are not really after saying that they have to be negative. Look, I mean, over here, the local time risk premiums are actually counteracting the positive risk premium on the future. So statistically, if you bootstrap it, it's indeed possible that they would be zero. But that is different than some of the implications that people have derived for, say, monotonic pricing kernels, which is essentially saying that as you increase the strike, the call returns will become more positive. But we can do a test of 3 versus 5, 5 versus 1, and see if this is getting more negative as you go more in the tails. Now, we also looked at the term structure of the equity option risk premiums. In the paper, we only focus on the first 4 maturities because they're most liquid in terms of open interest and volume. Here, I'm only showing it to you for 1 month and 3 months. And you can see from here that this is an 11 delta, which is 5%. And this is 10 delta for which is 12% out of the money. I mean, as you are increasing the maturity, you cannot just fix the strikes or the moneyness because the standard deviations are actually increasing for these overlapping returns. So you have to go out and go in the space of the deltas. Over here, we have the put option returns, and this is basically a 3 delta, 9 delta, and then this is 1% out of the money put. They're all negative, just like I indicated to you earlier. So it means that here, if you see over here, that a 10 delta call for 3 months, it has a 66% average, negative rate of return. So we are essentially showing how the dark matter is actually entering into these option returns, and how the two terms on the risk premium and the local time risk premiums are actually counteracting one another for the calls, which is consistent with the presence of unspanned risk. Now, the theorem that we have in the paper is essentially that if there are no unspanned risk in the pricing kernel, then the local time risk premium would be 0. Okay, and that is the important point that we are trying to hammer in this paper, that the pricing kernel should have some unspanned risk. Volatility should have unspanned risk. And these two features of the data are leading to a local time risk premium, which is showing up in deep out of money call returns. It's going to be very hard to identify these unspanned risks, directly from the returns, but you have to identify them from the claims to the upside, and also from the straddle returns. Now, we also looked at the things conditionally. So here in the blue, I have these option returns in the state where the quadratic variation is greater than the mean. Why did we use quadratic variation? Because quadratic variation is naturally naturally connected to the local time, but we can also use dispersion risk premiums. And here you can see that that this term over here is saying that if the quadratic variation is actually greater than the median over here, then the sum of the two is actually representing average rate of return to calls. So this term is actually positive over here, but the theory that we have is basically saying that the two terms will actually counteract. So it means that when the quadratic variation is greater than the median, then the expectation, it's a conditionally varying expected rate of return on the upside that can dominate the local time risk premium in certain states. We're not saying, but unconditionally, on average, the local time risk premiums are negative, and that's what you're seeing from the straddle returns over here. Now, when you go to the butterfly spreads, you have a similar story that in both the states, they are negative, and also these are essentially 10 delta, and if you do ATM vol, they're also negative. Okay, so we have many other examples in the paper. We're still trying to position these conditional returns, because how do you condition on what variable? You can condition on 1,000 variables. So it's a matter of where and how, what is the most intuitive way of doing it. But we thought in order to make this point about quadratic variation, that in certain states, it can happen that the conditional equity premium on the upside can dominate the local time risk premiums. Okay, so that's why we have this example over here. Now we are.
Sorry for interrupting. Gurdip, you still have 2 minutes.
Okay.
Thank you.
Yeah. So we also have some additional evidence on unspanned equity volatility, which is what we have over here. And the whole idea is that volatility tends to rise as equity index returns fall, but there's not a perfect correlation. If there were no unspanned risk, then that correlation would be perfect. But as you can see from the data, it's not perfect. So it's basically saying that some of the things are all going to jibe in if you look at evidence from different perspectives. I just wanted to introduce one very simple point over here, that we started looking at call option returns and predicting call option returns. But over here we use all the traditional predictors like in Goel and Welch and other people that that I've used. We also use some empirically inspired option predictors like quadratic variation. But now we are moving into a slightly different territory and doing a little bit more work on this. But what we are finding so far is that according to the joint p-values from the new US and Hardrick, we are failing to reject the null of no predictability. Okay, and also adaptive elastic NAT procedure shows that the best model of option returns is a constant. So this is also true for the straddle return. So it means that if you're trying to predict some component of the dark matter, it's indeed dark. It gets darker if you try to predict these things, and we'll have more evidence on this as we have the international data organized and we can run panel regressions. So just 1 minute, I just wanted to introduce what we did with the Heston model. So what we're doing different than the Heston model is we include the unspanned risk, and we include unspanned risk over here. And we look at the following structure of the pricing of the unspanned risk by the Gersanov theorem. Then the key results that we are finding is that the expected excess rate of return of OTM calls can be negative if and only if you have unspanned risk in the pricing kernel. If not, then you're not going to be able to show it. So this is a modification of the Heston model to allow for, you can think of that if you have the following structure, which is a downward sloping pricing kernel, then you need to add another term over here, which I call AT or UT, unspanned component. If you do it that way, then you'll be able to do it. And this has to be priced. Otherwise, you're not going to be able to explain in negative returns to the calls for low delta. So what do? We consider a pricing kernel that has both spanned and unspanned risk. And what we show is that the presence of unspanned risk and equity volatility is crucial. And we use this in a Tanaka's formula under P and Q to build model-free general characterizations. We try to identify the dark matter from the option returns. And we show that the local time risk premiums have to be negative. And our evidence points to lots and lots of dark matter. There's a lot to explain and understand, and we can do this by looking at the call option return. Put option returns are useful but the main way to identify the dark matter and to disentangle its presence or its importance in the data is to look at call returns, because that's where they're offsetting one another. Thank you so much for listening, and I look forward to Winston's discussion.
Thank you, Gurdip. So the discussion is Winston Du from Wharton. Winston, you have the floor.
Thank you. Let's go. So let me share mine. So Pascal, can you see the slide?
Yes, we can.
Great. Hello, everyone. Thank you for the opportunity to discuss this interesting paper by Gurdip and John and Xiaohui. I started to learn Gurdip's papers on options since I was a student at MIT. So I still remember we spent a lot of time to replicate Gurdip's papers, options in Junpan's PhD class. We always learn a lot from those papers. Same here today. I enjoy reading this paper and I've learned quite a bit. But before moving to the detailed discussion, let me first give one minor suggestion for the authors. So I feel the title might be a little bit too long. Yeah, even I exaggerate a little bit here by putting the large font size, but still you see it's 3 lines. It's kind of long. Shorter titles can help the paper to circulate. Okay, now let's get into the serious business. This paper tries to address a question: how to understand negative risk premium of options. That's my angle of this paper. To me, this is definitely very important. This is a research question of first importance for asset pricing researchers, not only because it is about a puzzling pattern on option pricing, but also much more broadly, it can help us, the key idea here can help us to understand the asset pricing patterns of other assets in the capital market. For example, this firm's investment growth options and uncertainty together can explain the value premium puzzle, right? This is particularly in my own paper, though 2017, there I kind of show that the growth options, the growth options as this kind of this R&D projects as growth options are essentially those kind of like short-term out of money call options like here discussed in Gurdip's paper. So because the investors, they don't like this high uncertainty, don't like a volatility. And at the same time, those kind of growth options of firms serve as a natural and very effective hedge for those like, unpleasant uncertainty shocks. That's why in the data we say the growth firms, on average, they have high expected returns, lower expected returns relative to the value firms. You see, here, amazingly here, this is exactly the idea in this paper. So, but very differently, the author looked at the options on SP 500 futures. I like it a lot because here, as a laboratory, the option prices provide a much cleaner and a neater and a simpler laboratory framework, to examine this fundamental economic mechanism. And as I just said here, the authors document that the short-dated out of the money options have negative expected excess returns, and as additional support evidence, like Gurdip presented, they have like a different extensive set of like supporting evidence. One is the straddles also have negative expected returns. So I will focus on this mean prediction. The short-dated out-of-money options have negative expected excess returns. So why that's interesting? Because this poses a challenge to the standard Black-Scholes-Merton models and their traditional extensions, because in those models, the short-dated out-of-money options are simply levered understanding underlying index, okay? That's why they should carry positive risk premium excess return. This is exactly why, outside the option literature, in the asset pricing literature, there's a value premium puzzle. That's exactly why the value premium puzzle is a puzzle. It's a challenging puzzle, okay? And in this paper, to understand this puzzle, provide a rationale, the authors using a dark matter-based asset pricing model, just like Einstein's theory for the universe, okay? And also this dark matter, the authors not alone, as Campbell in his textbook 2018, and our papers, my paper with Hui Chen and Leon Kogan at MIT, we show that this prominent macrofinance models, such as long risk models, 10-variant disaster risk models, they are all dark matter-based models, like Einstein's theory. So it's quite interesting. So more particularly in this paper, different from those models, the authors introduce a volatility factor that is latent, but it has to be assumed to be negatively priced by the investors. Okay, at the same time, this volatility factor, it's orthogonal to the underlying index returns, which means it's not spanned by the underlying index returns. Okay, so that's the key dark matter of this paper. So let me use like simplified equations to go through again about the basic setup. Gurdip already did a very good job. So let me just using very simplified version. You can see Gurdip use a very extensive and generalized formulation. Here I use very simple ones. So basically, how to think about this asset pricing models? Usually, the way we think about all asset pricing models, first we need to specify fundamentals. What are the fundamental dynamics? Okay, so in option pricing models, typically they are the underlying stock prices. So this is ST. So very, very standard ETO process with time varying volatility. And this variance VT following this mean reverting process. But importantly, here you can see it's driven by a latent additional factor, WT. And this is if theta is 0, it's gone. If theta is non-zero, it's driven by this. But here, let's just assume theta is positive. Okay. And the second step for all asset pricing models is SDF. Given the fundamentals, we need the SDF, and then we know how to price these fundamentals. So here, the SDF is assumed almost like a standard here, but additionally assume this latent volatility factor is priced. And it's negatively priced. This lambda market price of risk, lambda is negative. Why? It's very natural. Actually, tons of like, asset empirical theory asset pricing papers assume this volatility is not welcomed by the investors. Investors hate high volatility. That's why this lambda is negative. And then in equilibrium, you can link this expected stock return UT with this, the risk-free rate and the loadings and market price of risk. Okay, so in my slides, I will assume R equals 0. In that case, I can just focus on ST. Otherwise, I need to talk about, like in the paper, you can talk about the futures price. But here, I assume R equals 0, so I can just focus on ST. The key part, the basis of this theory of this paper is very nice. I learned this from, I have to admit, I learned this from this paper. Very nice formula, mathematical result. This is like, you can think it's like an extension of very standard Taylor expansion or Ito's lemma expansion, but it work for this kink function. Okay, so we have this because this is like a difference between S capital T and the S0, and then this is the first order derivative of the kink function, and the delta function is can be viewed as the second derivative of the kink function. And then given this nice formula, we can just see the expected access to return of the call options very nicely. So it's just a difference between this physical expectation and the risk neutral expectation. Because of R equals 0, so the risk neutral expectation for this term is 0. It's gone. So what's left is this term, the physical expectation of this first order term. And this term, as discussed very carefully in this paper, that's why we focus on this short-dated out-of-money call options, because when you are, out of money and short-dated, most likely this indicator function will be 0. So on average, this term will be close to 0. It's a small term quantitatively. Then what's dominant? This is the second order term. That's the difference between the physical expectation and the risk neutral expectation of this second term. And what's the second term? I give a name local variance risk premium. Maybe it's more intuitive, but more formally, I'll also define like local time risk premium. But a very intuitive is like a slice of the total variance risk premium. Okay, so Why? Because this is a second order term, and it depends on this quadratic variation of the price process SD. Okay, and if you write it out, eventually it will be like almost proportionally depend on this theta times lambda. Remember, what's theta? Theta is how much of this volatility load on this shock W, and the lambda is how much this W shock is priced. Remember, theta is positive, lambda is negative, which means it's bad shock. That's why this is negative. And when this term is large, it's huge. So this second order term will be dominant. That's why for this short-dated out-of-money options, the excess return is negative. Okay, this is very nice, very clear. More intuitions, like I said. Okay, here actually nicely the authors provide this formal connection between the total variance risk premium, this is usually empirically how we compute, that's the definition, and this local variance risk premium. It's just like weighted average. There's a weighting function across all strike prices from 0 to infinity. Okay, it's a very nice result. And the economics is just like I've been repeated many times. It's very clear, but very important, I would say. It's not only for the options. This same idea can be carried to understand other classes of assets. I think the authors should emphasize this in the paper to make this paper draw more like broader interest from in the asset pricing literature. So basically, this short-dated out-of-money options offer effective hedging against the VT. And because they are short-dated and then out of money, they have low implicit leverage. So they have low sensitivity to the shocks in ST. That's why this term is almost zero. And then at the same time, they have, because now it's short-dated and out of money, if you look at this option pricing function, it's like almost close to the kink function. That's the time or situation this convexity is largest. That's why the strongest asymmetric effect. So we have this option price has high positive sensitivity to this volatility shock. That's why that's why this second order term will be large and negative. That's the key intuition. So now come to my point. The first one is I really love this paper. Actually, to be honest, I told Xiaohui actually many years ago when Leonid and Hui we worked on with the perfect setting to study dark matter is the option setting, or like the interest rate term structure setting. But it's great, this paper, they focus on this. But I think the authors can do a better job in the paper to really explain the logic of dark matter here. So for example, the key thing is, because it's latent and we don't really know, and unspanned in the stock returns, so we don't really know what this WT is. And given this, we don't really know what is theta and the lambda. And why this is dark matter? Because we assume, even we don't know, we have no clue, but in order to make this all asset pricing formulas fall out and held, we need to assume the investors inside the model knows perfectly what is this latent factor, knows perfectly what is the value of theta, what is the value of lambda. So we need to provide justification why investors inside the model knows all this. And more precisely, so if you
Winston, sorry for interrupting, Winston, you have 2 minutes left.
Okay.
Thank you.
So more precisely, so if you only use fundamental data, you have wide confidence region about this theta parameter. But once after you're imposing the model and the returns of options, you suddenly like identify the theta, have very precise estimation, which means all the identification information comes from this pricing model, which can be misspecified. So in my paper and with Hui and Leonid, we kind of say what's the concern about this excessive dark matter? One is low refutability. It's hard to reject this kind of models. Second, these models tend to have a poor auto sample performance of fit because of the high in sample overfitting. So the author, I think the author, if really talk about dark matter, this is a direction to go. It's like can help the paper to contribute more to the literature to study this out-of-sample performance. So how to mitigate this concern of dark matter? So two exercises I will suggest. One is extend this kind of like baseline model. You explore this cross-section of option prices with different strike prices, right? Okay, so you use this like the log strike, which is 1%, 5% as a base, okay? And then you ask the model, you will get theta and lambda and test how well the asset model fits the, the call options with strike price, log strike price equal to 0.03%. See how well that will fit. And then another way to do it, you extend this like a baseline by not only look at this market returns or index returns, you look at whole cross section of stock returns. There, based on your baseline model, you can first try to filter out this WT and estimate theta using this method, filtering method in Andrian and Rosenberg. It's a very simple method. And then you use cross-section stock returns to estimate this lambda market price risk of this filtered out volatility factor. And then you plug those parameters into your models, see how well they can explain this out-of-money call options. So these are the ways to try to, to mitigate, those concerns on this kind of like a dark matter-based theory. Here it's just the paper is still ongoing, but I think if we want to treat this model seriously, we need to have a formal comparison with other, prominent option models, like in the Summer paper by Bakshi, Cao, and Chen. That's the paper, by the way, we replicate when I was a student. I really love that paper. So it's like compare with standard Black-Scholes models, the stochastic volatility models, and other models. And in terms of like in-sample fading, and out-of-sample performance and dynamic heading errors. And last, the meta point is the authors mention this emphasize market incompleteness in the paper, but I want to say this unspanned risk that is not equal to they're not treatable. Actually, in the model, they are treatable, right? Given you have like options with different strikes and different maturities, they're treatable. So the market is complete. And also, I don't think the market incompleteness is essential, is needed to achieve any of the key results in the paper. The second is, in one of the analysis about this evidence to show the existence of this additional latent volatility factor, the authors, just to say, okay, based on the volatility is complete, if volatility is complete span by the equity index returns, so these two, the underlying index returns and the volatility are perfectly correlated. It's not the case. The statement is not right unless the loading matrix, it's not full rank, right? Even in this very simple example, you get rid of this latent variable, latent factor WT, and you have two other factors, and the loading matrix, the sigma is not, it's a full rank. In that case, the stock return, the underlying index return and volatility still, they are not perfectly correlated. Okay, to conclude, it's a very nice paper and an interesting topic, and the paper show negative expected excess return consolidated out of money call options, and propose a plausible model relying on dark matter. And I think the key idea can be very useful not only for option pricing, but for like in microfinance, in general asset pricing. Yeah, so my suggestions for possible improvement is discuss more about like out-of-sample fit analysis in the cross-section and in the time series, and formal comparisons with alternative models. And to emphasize this market incompleteness is not needed, make the theory more, more general. Yeah, thank you.
Thank you, Winston. Gurdip, do you want a quick response? We're almost out of time, so please a quick response from Gurdip.
Yeah, thank you so much for your comments. We will reach out to you and we'll talk about all the important suggestions that you are saying. Regarding market incompleteness, all we are saying is that it's not spanned by the primary asset. It could be spanned by options, and
I see.
There is a line in the paper. We say that. So
Okay.
when we say market incomplete, it's just the primary yes.
Yeah. Yeah.
So and we look forward to working on all the things that you suggested. And maybe okay. Thank you so much. Thank you.
Thanks, Gurdip. I don't see any question on the chat box, but maybe we still have time for one quick question. Nope. Okay, well then, we're almost out of time, so I want to really